This decade's greatest investment opportunity is still Nvidia. It may even be the greatest experience of your life. The real question is, what is the terminal value? I believe that NVIDIA's revenue scale will likely continue for the next 2 or 3 years. SAC demonstrated the same thing in that Cisco slide. In the end, people discovered that the value would be allocated to the application layer, which is another element of the stack. As more and more funds were raised at the Internet's application layer, Cisco received less and less credit and revenue multiple. And since Cisco's revenue kept increasing, that isn't a bad thing. It's Monday, another week in the U.S. markets, and Caroline Woods is at the New York Stock Exchange this morning with some analyst notes and commentary. Let's talk about some Nvidia, Caroline. What about that? Indeed, Nvidia is always making news and is receiving another price target increase on Wall Street. However, a quick glance shows that shares are rising, up roughly 0.7% this morning and continuing to rise today. They had already gained 9% last week, 20% so far in June, and 166% so far this year. Today, they continued to build on those gains, up slightly less than 1% as I mentioned. Susano was the analyst that increased their price target for shares to 160. They'll go over why Nvidia is expected to grow significantly and why its stock is a good investment over the course of the next 10 minutes. In the market for AI chips, Nvidia has solidified its position as a leader. The need for AI technology is rapidly growing in a number of industries, such as healthcare, banking, and the automotive sector. At the heart of this technological revolution are AI chips, which allow for more complex machine learning algorithms and speedier processing. For AI applications, Nvidia's cutting-edge GPUs, graphics processing units, are now the industry standard. Because these processors are built to withstand the massive processing demands of AI jobs, Nvidia is the preferred supplier for businesses wishing to incorporate AI into their operations. In the upcoming years, the market for AI chips is anticipated to expand considerably. Industry predictions indicate that as more industries embrace AI technologies, the market may grow to previously unheard-of heights. The growing dependence on AI for data analysis, automation, and decision-making processes is what is driving this increase. Nvidia is in a great position to benefit from this development. It stays at the forefront of this expanding sector because of its ongoing innovation in AI technology software. Nvidia is not only meeting but also exceeding demand by consistently enhancing the functionality and efficiency of its CPUs. Innovation is at the heart of Nvidia's strategy. The corporation is not happy with resting on its laurels. Instead, it continuously pushes the frontiers of what its technology can produce. Recent breakthroughs in Nvidia's chip architecture have resulted in major performance enhancements, further consolidating its competitive lead. For instance, Nvidia's recent introduction of the Hopper GPU architecture represents a significant leap forward in AI processing power. As AI models get more intricate and demanding, this new architecture promises to deliver performance never before seen. Yes, and they performed a fantastic job. However, the worth was reduced. So, Freeberg, if we're looking at this chart, the winner of Netflix, the winner of the Cisco chart might, in fact, be somebody like Netflix. They actually got, hundreds of millions of consumers to give them cash and Facebook. And then you have Google and Facebook as well, providing all that traffic, and then you too, of course. In your opinion, who is the application layer victor here? Who are the billions of customers who will spend $20, $5, or any other amount each month? That being said, let me begin with this crucial issue, the chat's point. If you look at where that money is coming from, it comes from large cloud service providers. As a result, Google and other companies are creating clouds on which other application developers can construct their AI tools and applications. Therefore, a large portion of the build-out is located in cloud data centers that are owned and run by these large technology corporations. Although Nvidia made $18 billion from data centers, the businesses that are expanding do not consider it an operating expense. Thus, this is a crucial factor in explaining why things are happening so quickly. Large corporations purchasing these chips from Nvidia are exempt from accounting requirements to record the purchase as an expense on their income statement. In the cash flow statement, it is actually recorded as a capital expenditure. Over time, they depreciate it and record it on the balance sheet. And so, they can spend $20 billion of cash because Google and others have $100 billion of cash sitting on the balance sheet, and they've been struggling to find ways to grow their business through acquisitions. One of the reasons is there aren't enough companies out there that they can buy at a good multiple that can give them a good increase in profit. The other is that all of their purchases are being blocked by antitrust authorities. So how do you spend all that money? The next generation of cloud infrastructure can be built out without negatively impacting your profit and loss. After it is recorded on the balance sheet, it is depreciated over a period of 4 to 7 years. Thus, over a 7-year period, that money is distributed on these large corporations' income statements. The large cloud data center providers are stepping in to say that now is a great time to build out the next generation of infrastructure that could generate profits for us in the future, because we have all this cash sitting around due to a really great accounting and M&A environment driver. The P&L doesn't have to suffer. We don't need to buy a company that is losing money. To be honest, antitrust laws will prevent us from expanding through mergers and acquisitions at this time. As they look for ways to expand, a number of additional driving forces are contributing to this short-term acceleration. Yes, let's discuss the recent performance of Nvidia's stock. Nvidia's stock has been on a tear, reflecting the company's robust growth and market potential. As a result of the company's strategic posture and investor confidence, Nvidia is currently the second most valuable stock in the world. Impressive financial data support this stock's explosive increase in value. For example, Nvidia's data center revenue grew a staggering 427% year-over-year, reaching $22.6 billion. This expansion highlights the growing need for AI solutions in the data center industry, a trend that is probably here to stay. Nvidia's financial performance has been nothing short of spectacular. With its recent profits per share announcement of $6.12, the company comfortably outperformed the average forecast of $5.60 per share. Such strong earnings are a clear indicator of Nvidia's operational efficiency and market dominance. Furthermore, Nvidia's outstanding 78.4% gross margins put it well ahead of the competition. High margins reflect the company's ability to command premium pricing for its advanced products, further enhancing its profitability. Given these factors, it's no wonder that analysts are bullish on Nvidia. Despite the recent spike in its stock price, many people think Nvidia is still cheap. The company's strong market position, coupled with the anticipated growth in the AI sector, makes Nvidia a compelling investment opportunity. In conclusion, Nvidia is not merely leading the AI chip industry, it is shaping the future of AI technology. With a great track record of innovation, exceptional financial performance, and a clear roadmap for future growth, Nvidia is well positioned to sustain its market leadership. Analysts are positive about the company's potential, making Nvidia a solid buy in the eyes of many investors. I know that was an accounting point, but I think it's a really important and valid one. If $100 billion gets spent this year, you divide it by 4. That, or anything close to it, would have to generate $25 billion in revenue. Yes, and so any guess is Sachs. You have to just bear in mind, I think, Freeberg, what you stated is extremely accurate for GCP spend, but not necessarily for Google spend. It's true for AWS spend, but not necessarily for Amazon spend. And it's true for Azure spend, but not true for Microsoft spend. It's basically not true for Tesla and Facebook, since they don't have clouds. So I believe the question, to your point, and for obvious reasons, Nvidia doesn't reveal it, is what is the percentage of that $21 billion that just went to those cloud providers that they'll then expose to everybody else versus what was just absorbed? That's all for Mark, isn't it? He had that video on Facebook about how many H100s. However, my point is still capitalized, so they don't have to register that as an expense. It sits on the balance sheet, and they can earn it down over time. Since these large cloud service providers are extremely profitable and have nowhere else to put the money, you're helping to explain why they're spending so much money, right? Thus, it would appear that this falls more in the category of one-time build-out than steady long-term revenue. The main query, in my opinion, is the one that Jim Math posed. What is NVIDIA's terminal value? I think a basic framework for thinking about that is what is the total addressable market, or TAM, connected to GPUs, and then what is their market share going to be? Their current market share is approximately 91%. That will undoubtedly be defeated, but their moat seems to be huge. The Wall Street analysts I've been listening to think